A massive 8.4% rally in consumer discretionary powered the broader market green during the latest session as key stock indexes pushed higher. The VanEck Semiconductor ETF rose 0.3%, with moat durability data currently unavailable. Behind this modest tick lies massive demand for Nvidia's next-generation Blackwell chips, where hyperscalers are committing tens of billions in capital expenditures to secure early compute capacity. Our full teardown reveals whether hardware supply constraints will limit execution across the fund's key semiconductor holdings. SMH gained 0.3% to reach $540.53, while broader tech stocks saw mixed profit-taking across major indexes. The moving average alignment currently signals a bearish short-term trend for the vehicle. Yet the relative strength index sits at 39.2 in neutral territory, ruling out immediate oversold conditions. Institutional capital continues shifting inside the hardware supply chain. Nvidia holds 17.8% of the fund and faces intense profit-taking pressure from high-profile short sellers. Taiwan's semiconductor represents 9.2% of NAV, driven by absolute market dominance in advanced node manufacturing. Micron holds a 5.8% weight as memory demand collides with shifting chip architecture requirements. Meanwhile, Samsung Electronics and Broadcom expanded their strategic collaboration across memory and foundry technologies. This structural deal directly impacts high-bandwidth memory supply chains across the sector. While financial media emphasizes macro headwinds, holding mechanics confirm capital is concentrating into pure hardware bottlenecks. The top 3 holdings drive over 32% of total fund price movement daily. Year-to-date gains of 82.3% prove that market leadership remains locked in front-end silicon fabrication. This creates a severe single-node exposure risks for retail investors expecting broad sector diversification. Investors must recognize that SMH is an engineered bet on leading-edge semiconductor capacity. The lab views this structure as a targeted proxy for advanced AI accelerator infrastructure. High concentration turns minor pullbacks in flagship chip makers into severe structural drawdowns. Open the hood on the VanEck Semiconductor ETF. The largest single dragging, MU at minus 5.9%, carrying 5.8% of the fund. VanEck markets SMH as a semiconductor benchmark, but asset and expense disclosures remain unlisted in current data. The performance record speaks clearly with an 82.3% gain year-to-date and a 50.4% 3-year average. Fund structure is heavily top-weighted. The top 5 holdings represent 43.9% of the total fund weight. Nvidia dominates at 17.8%, followed by Taiwan Semiconductor at 9.2% and Micron at 5.8%. Applied Materials takes 5.7% while AMD sits at 5.4%. Marketing documents promise diversified sector exposure to retail investors. The actual holding mechanics deliver high concentration in top-tier silicon leaders. This heavy tilt explains why SMH beat rival ETF SOXX by 2.1 percentage points over the past month. SOXX fell 10.8% over that period as broader legacy chip names stumbled. SMH captures pure AI infrastructure momentum while shedding legacy semiconductor drag. Applied Materials provides critical exposure to wafer fab equipment spending that anchors long-term hardware capacity. AMD adds secondary exposure to enterprise accelerator deployment. Federal Reserve policy sits at 3.63%, while CPI rests at 0.6% YOY. Moderate macro conditions allow institutional capital to focus strictly on earnings power. Yet a 43.9% concentration in 5 names makes diversification claims pure marketing spin. The fund functions as a concentrated mega-cap technology vehicle rather than a broad industry basket. The lab evaluates SMH as a highly efficient mechanism for capturing front-end hardware dominance despite concentration risks. Here's the money flow story on SMH that Wall Street is missing. That 1.60x 5-day to 20-day volume ratio isn't just noise. It's strong institutional inflow, plain and simple. Capital is positioning into semiconductors, even as the tape flashes red. price is below both the 20-day and 50-day moving averages, RSI at 39.2. So momentum is still pointed south, but the volume tells us the big players are buying the dip, not bailing. Now look at the NAV premium. SMH is trading 34.7 basis points above net asset value. That's demand pressure, not panic. Retail isn't dumping. They're paying up for exposure, which means the narrative around tariff risk isn't scaring them off yet. But here's the disconnect. Fund marketing still sells SMH as a diversified tech play, yet the top 5 holdings are nearly 60% of the fund. The macro narrative says trade war escalation, but the flow says institutions are treating it as a buying opportunity. The lab's verdict: SMH is structurally long AI hardware, not software, and the volume flow confirms capital is chasing the next wave of neural network accelerators. 12 nanometers bit serial CNN chips for XR wearables, heterogeneous RF signal processors, while the tariff headlines are just noise. The premium to NAV proves the narrative filter is broken. The money is following the silicon, not the tweets. The durable case for SMH rests on Nvidia launching next-generation Blackwell chips to satisfy massive orders from hyperscale corporations. This product rollout anchors the fund's 82.3% year-to-date return by driving direct revenue to key holdings. The primary structural risk stems from strict U.S. export limits on AI chips to China. These sanctions directly choke revenue for major holdings like Nvidia and AMD without immediate domestic offsets. Furthermore, sudden pullbacks in corporate tech spending leave chip makers holding excess inventory they cannot sell. For our evidence watch, 2 structural signals determine future vehicle durability. First, monitor the 26.9% weight concentration in Nvidia and Taiwan Semiconductor. Any operational breakdown in Taiwan's Strait supply chains instantly freezes global silicon manufacturing. Second, track sentiment shifts as the CNN Fear and Greed Index touches 25 in extreme fear territory. Extreme fear historically precedes ETF structural bounces as retail capitulation completes. The ETF offers zero buffer against macro policy shifts targeting semiconductor trade routes. Physical hardware capacity defines the ultimate ceiling for fund valuation. The lab assigns SMH an AI ETF score of none out of 100 based on fund structure durability. The key metric that alters this structural judgment is enterprise capital expenditure growth among top cloud providers. If corporate spending contracts, high holding concentration accelerates downside tracking error against broader tech indexes. SMH remains an engineered high beta instrument designed for maximum exposure to leading-edge hardware production cycles. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 3.3%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. We're watching SMH's moat in real time. No data, no noise, just silence. Is the VanEck Semiconductor ETF's moat strengthening or eroding? Let's hear your evidence. This isn't financial advice. We're engineers, not brokers. Markets move fast, data lags, and past performance never guarantees. Do your own research before you trade. Subscribe so you catch the next signal before Wall Street. Stay sharp, the lab's out.